Well, the issue is those two markets are actually not telling too different of a story. I know that they look like they're really divergent, but they aren't. So the bond market, again, is pricing in lower growth, lower inflation expectations, and a resultant Fed policy response. Whereas the stock market, again, you're pricing cash flows off these lower rates. You've got an accommodative Fed, and that's very positive for risk assets. So I think we're kind of looking at two sides of the same coin. So not too divergent. And that's the same story in credit as well.
Right. And the impact on equity risk premium, Margaret, I mean, that's always been the argument that lower bond yields can pave the way for higher valuations. But at some point, does that break down? Is there a limit to which lower rates will actually help stocks and actually indicates that there's something wrong with the economy?
Yeah, well, you have to remember why rates are going down in the first place. They're going down because fundamentals are weakening, right? So, I mean, we have 17% move in the S&P 500 year to date. If you said, is it going to be up another 17% second half of the year? Probably not. And so, you know, I mean, as we look at it, I think the big difference for us is that we're looking at last year, things were expensive too. Right? But fundamentals were really good. GDP growth was approaching 4%, and especially tech results were phenomenal. Now we have a market where things are still good, but they're not quite as great as they were last year, and valuations are just as expensive.
I think that's important to understand the context for these record highs and the previous highs when we were at these same levels. It's a very different context.
It's a very different context. And last year, remember, we were benefiting from tax reform. So, of course, S&P earnings were up really strong. But I pulled some numbers the other day, which was that 81% of the tech names in the S&P 500 beat in the second quarter of 2018 on revenue. So not even benefiting from tax reform. This year in the first quarter, that number is 69%. So you can clearly see that the fundamentals are still good. 69% beat is good, but not quite as good as last year.
Well, and Karissa, I'm just wondering about the fixed income performance this year, which has been amazing. I mean, when we wake up to headlines that global bond yields are as low as they are, is there any value left in your space?
Well, there is. You have to remember, too, the bond market is really kind of supposed to be the ballast, the risk mitigator in portfolios. But this flight to quality that we've seen because of concerns about global growth and inflation has pushed bond market performance to extremely strong numbers.
Yeah, if I could give you an anecdote on that. Rick Reeder was on a halftime report yesterday, and he said in Europe, and maybe to some extent here, people buy bonds for the upside and equities for carry.
You know, there could be some truth to that. So, I mean, look at developed markets outside of the U.S. 20% of sovereign debt is now negative yielding. So that really leaves, you know, the U.S. market and the U.S. corporate credit market. Like, some of these markets are some of the only places left that you can get yield. So you don't want to just grab for yield, but again, there is a scarcity of other avenues out there to provide income, safe income for clients. So that's absolutely what's going on. You know, there is a surge here. If you look at long-term treasuries, those have returned well over 10% year to date, which is really striking.